Hey everyone! Welcome back to the channel. If you're studying for your insurance license, you've probably come across the term alternative non-traditional life insurance products. Sounds complicated, right? Don't worry, today we're breaking it all down into simple, easy-to-understand concepts. By the end of this video, you'll know all about adjustable life, universal life, variable life, and more. Let's dive in. Let's start with adjustable life insurance. Think of this as the Swiss Army knife of life insurance. It combines the features of traditional whole life insurance with the flexibility to adjust your coverage and premiums as your needs change. Here's how it works. 1. You start with a level premium and a level death benefit, just like traditional whole life. 2. But here's the cool part. You can adjust the death benefit or cash value in the future. 2. For example, if your income increases, you can bump up your coverage. 2. Or if you're tightening your budget, you can lower it. Example. Let's say Sarah buys an adjustable life policy. A few years later, she has a baby and wants more coverage. She can increase her death benefit without having to buy a whole new policy. The key takeaway? Adjustable life is perfect for people with changing financial needs, like growing families or fluctuating incomes. Next up is universal life insurance. This is another flexible option, but with a twist, it's interest sensitive. That means the cash value grows based on market interest rates. Here's how it works. 1. You pay a flexible premium. You can pay more or less each year depending on your budget. 2. Part of your premium goes toward pure protection, like term insurance, and the rest goes into a cash value fund that earns interest. Example. Imagine John buys a universal life policy. In a good year, he pays extra into the policy, and the cash value grows faster. In a tight year, he pays less, and the policy uses the cash value to cover the costs. But here's the catch. If you don't manage it well, the policy could lapse if there's not enough cash value to cover the costs. So it's great for disciplined savers. Now let's talk about variable life insurance. This is where life insurance meets investing. Here's the deal. 1. You pay a fixed premium, and part of it goes into a separate account invested in stocks, bonds, or mutual funds. 2. The cash value and death benefit can increase if the investments perform well, but they can also decrease if the market tanks. Example. Emily buys a variable life policy and chooses to invest in a stock fund. If the market does well, her cash value grows and her death benefit increases. But if the market crashes, her cash value drops, though the death benefit won't go below the guaranteed minimum. One thing to note. To sell variable life insurance, you need both a life insurance license and a securities license. So it's a bit more complex, but offers great potential for growth. Next, we have variable universal life, VUL. This is like a hybrid of universal life and variable life. Here's what makes it unique. 1. You get flexible premiums, like universal life. 2. You also get investment options, like variable life. Example. Mark buys a VUL policy and invests in a mix of stocks and bonds. If his investments do well, his cash value grows, and he can even skip premium payments for a while. But if the market underperforms, he might need to pay more to keep the policy in force. VUL is great for people who want flexibility and are comfortable with investment risk. Finally, let's look at some special use life insurance products. These are designed for specific needs, like estate planning or family protection. 1. Joint life policies. Covers 2 people, like a married couple. Pays out when the first person dies, first to die, or the last person dies, second to die. 2. Family plan policies. Covers the whole family under one policy. And the primary insured gets whole life coverage, while the spouse and kids get term coverage. 3. Juvenile insurance. Covers children and often includes a jumping benefit that increases when the child reaches adulthood. 4. Endowment policies. Pays out a lump sum after a set period like 20 years, or at death, whichever comes first. These products are perfect for specific financial goals like funding a child's education or protecting a family's future. One last thing, modified endowment contracts, MECs. These are life insurance policies that are overfunded according to IRS rules. Here's what you need to know. 1. If you pay too much into a policy in the first 7 years, it becomes an MEC. 2. MECs lose their tax advantages, and withdrawals are taxed as income. Example. If Sarah withdraws cash from her MEC before age 59.5, she'll pay a 10% penalty on top of regular taxes. So MECs are great for cash value growth, but you need to be careful with the funding limits. And that's it. You now know all about alternative non-traditional life insurance products. Whether it's the flexibility of adjustable life, the investment potential of variable life, or the specialized coverage of joint life policies, these products offer something for everyone. If you found this video helpful, give it a thumbs up, subscribe for more insurance tips, and hit that notification bell so you never miss an update. Got questions? Drop them in the comments below. I'd love to help. Thanks for watching, and good luck with your insurance studies.